Summary of the Intelligent Investor by Benjamin Graham. Introduction. The Intelligent Investor, written by Benjamin Graham and first published in 1949, is often regarded as one of the most important investment books of all time. Graham, known as the father of value investing, presents a comprehensive philosophy that emphasizes a disciplined approach to investing, the importance of analysis, and a long-term perspective. The book aims to guide investors in making sound financial decisions, reducing risk, and achieving sustainable returns. Key concepts and principles. 1. The two types of investors. Graham differentiates between two types of investors: defensive or passive. Investor sensing. This type seeks to minimize risk and preserve capital while achieving reasonable returns. Defensive investors prefer a hands-off approach, investing primarily in high-quality stocks and bonds. Sing enterprising or active. Investor sensing. This investor actively seeks to outperform the market through research and analysis. Enterprising investmenters are willing to dedicate time and effort to analyze securities and identify undervalued opportunities. 2. The importance of a margin of safety. One of Graham's core principles is the concept of the margin of safety. This principle suggests that investors should only purchase stocks when they are priced significantly below their intrinsic value. The margin of safety acts as a buffer against errors in judgment, market volatility, and unforeseen circumstances. By investing with a margin of safety, investors can reduce their risk and increase the likelihood of achieving positive returns. 3. Market fluctuations and investor behavior. Graham highlights the importance of understanding market fluctuations. He argues that the stock market is driven by emotions and can often lead to irrational behavior among investors. He introduces the idea of Mr. Market, an allegorical figure representing the stock market, who is unpredictable and driven by emotions like fear and greed. Intelligent investors should remain rational and not be swayed by market fluctuations. 4. Fundamental analysis and security valuation. Graham advocates for fundamental analysis as a method for evaluating securities. He emphasizes the importance of assessing a company's financial health, including its earnings, dividends, assets, and liabilities. By conducting thorough analysis, investors can determine the intrinsic value of a security and make informed investment decisions. Key components of fundamental analysis include and can provide a reliable income stream. Balance sheet analysis. Investors should assess a company's assets, liabilities, and overall financial stability to gauge its ability to weather economic downturns. 5. Defensive investment strategies. For defensive investors, Graham recommends a set of strategies that emphasize safety and stability. Diversification, spreading investments across various asset classes, sectors, and geographies to reduce risk. Investing in blue-chip stocks. Blue-chip companies are well established, financially sound, and have a history of stable performance. They are often considered safer investments. Fixed income securities. Defensive investors should consider allocating a portion of their portfolio to bonds or other fixed income investments for stability and income. 6. Enterprising investment strategies. For enterprising investors seeking higher returns, Graham suggests more active strategies, including value investing, identifying undervalued securities that have strong fundamentals, but are trading below their intrinsic value. Contrarian investing, taking positions that are contrary to prevailing market sentiment, particularly when the market is overly pessimistic or optimistic. 7. The role of psychology in investing. Graham underscores the psychological aspects of investing. He emphasizes that successful investing requires emotional discipline and a strong mindset. Fear and greed can lead to poor decision-making, while a disciplined approach, based on rational analysis, can help investors stay focused on their long-term goals. 8. The relationship between risk and return. Graham discusses the relationship between risk and return, highlighting that higher potential returns come with increased risk. He emphasizes that intelligent investors must understand their risk tolerance and align their investment strategies accordingly. 9. Long-term investment perspective. Graham advocates for a long-term investment perspective. He argues that investors should not be swayed by short-term market fluctuations, but instead focus on the underlying value of their investments. A long-term approach allows investors to ride out market volatility and benefit from compounding returns. 10. The concept of Mr. Market. Graham introduces the concept of Mr. Market to illustrate the irrational behavior of the stock market. Mr. Market is a hypothetical character who offers to buy or sell stocks at different prices every day based on his mood. Intelligent investors should treat Mr. Market as a guide rather than a directive, taking advantage of his emotional swings to make rational investment decisions. 11. Investment policy and asset allocation. Graham emphasizes the importance of having a clear investment policy and asset allocation strategy. Investors should define their investment goals, risk tolerance, and time horizon, and allocate their assets accordingly. A well-defined investment policy helps investors stay disciplined and avoid impulsive decisions. 12. The importance of research and due diligence. Graham advocates for thorough research and due diligence before making investment decisions. He encourages investors to analyze financial statements, assess market conditions, and understand industry trends. By conducting thorough research, investors can make informed decisions and reduce the likelihood of costly mistakes. 13. Investment opportunities in various markets. Graham explores investment opportunities in various markets, including stocks, bonds, and real estate. He emphasizes the importance of understanding the unique characteristics and risks associated with each asset class. 14. The role of investment advisors. Graham discusses the role of investment advisors and the importance of choosing a trustworthy advisor who prioritizes the investor's interests. He cautions against relying solely on expert opinions and encourages investors to conduct their own research. 15. Common investment mistakes. Graham outlines several common investment mistakes, including chasing performance. Investors often buy stocks that have recently performed well, ignoring the underlying fundamentals. Timing the market. Trying to predict short-term market movements can lead to poor investment decisions. Overreacting to market news. Emotional reactions to market news can cloud judgment and lead to impulsive decisions. Conclusion. In conclusion, The Intelligent Investor serves as a foundational text for anyone interested in understanding the principles of value investing and sound financial decision-making. Graham's insights into market behavior, the importance of fundamental analysis, and the psychological aspects of investing remain relevant today. By emphasizing a disciplined and rational approach to investing, Graham provides readers with the tools and knowledge to navigate the complexities of the financial markets successfully. Through the concepts of margin of safety, long-term perspective, and the influence of emotions on investment decisions, Graham equips investors to make informed choices and achieve sustainable financial success. The book is not just a guide to investing, it is a philosophy that promotes a thoughtful and disciplined approach to wealth building, emphasizing that intelligent investing is a lifelong journey of learning and growth.